So thank you guys for joining us on this day. Today we're going to talk about retirement planning for you. A lot of you guys are retired or retirees or people planning to retire here shortly. So we want to make sure we're giving you guys some content, some shareable content. And of course, if you want to listen to this and you have to go away early, you can always go to the YouTube station, the Nine Innings Podcast. And we have these by the end of the day to be replayed on our YouTube station. So this will be on that station, hopefully by the end of the day. I'm Kevin Thompson. I am a CFP, which is Certified Financial Planner, or ICP, which is a Retirement Income Certified Professional, and an enrolled agent, which means I know a little bit about taxes. And that's what we're here to talk about today. We're here to talk about some common tax issues you retirees are facing. I know it seems like there's always something that you're dealing with, whether it be IRMAA or Social Security or Medicare or what have you. We're going to discuss a lot of that in this very, very short presentation. Again, I like to keep these short. I don't want to keep you here all day because you guys are retired or in retirement. And the last thing I want you to do is be listening to my voice all day long. You guys need to be on the slopes or hitting golf balls or doing something and letting me deal with all these headaches. So with that being said, let's start here with the retirement equation. Let's talk about what we have total control of, right? What we have total control of, where we put our assets and where they are located, the asset allocation, how they're invested, the asset location, where they're being invested, how much we're saving and how much we're spending. That's what we have total control over. But we also have to understand what we don't have control over, which again, market returns. That's me. I got to try to get you guys that. And that's what I'm doing for a lot of you guys right now. But again, I don't have necessarily control of what happens because as you can currently see, none of us really have control of what's going on. But it's ultimately imperative to understand that market returns are out of our control, and so are tax and, of course, regulatory benefits or regulatory situations as well. Now, from a retirement perspective, we have some control over employment and earnings. Are we going to continue to work? What does that look like? And we have some, some control over when we retire as well. So we have control over these things, and it's important to understand this retirement equation just on a high level. Now, fostering our well-being in retirement. I see this a lot of times with people. What employment gives them is structure. We have structured time. We know what we're doing every single day. We get up, we do this, and everything is structured. Just like in my baseball career, everything was structured. But when I leave, I feel like I'm a lost puppy, right? So now we transition ourselves over to this free time, right? We don't know what to do with ourselves. We've done such a great job getting ourselves to retirement, but a poor job getting ourselves ready for retirement. What is our purpose? How are we going to use our time? What does socializing look like? And then how are we going to foster health? So those are some of the things we need to be focused on as we approach retirement, or if we're in retirement, the things we need to focus on to make sure that we're using our time wisely and we're not necessarily left lost like I was after I left the MLB. Now, let's get down to the nuts and bolts of this thing. A lot of you guys, Social Security benefits. When should we take them? How should we take them? And taxation of Social Security benefits. It's one of those things what we have to kind of monitor. Are you a single filer? Are you a joint filer? Are you getting taxed 50 to 85% of that benefit is taxable and the other 15% or 50% is not? So we have to kind of figure out where you sit in that dynamic. A lot of my clients, of course, are in the 85%, of course, because they make more than that $44,000 of adjusted gross income. And of course, it's a very low number for some of you. But again, if we could identify how we can maximize the Social Security benefit, should we take it early? Should we take it later? Can we get a better bang for our buck? We'll definitely do that. But from this perspective, the taxation of Social Security benefits, majority of you will see your benefits taxed at 85%, which means that, yeah, you've paid tax. Well, you didn't necessarily pay taxes in the front end because they're just taking it out of your check, but now they're giving you that money back. And now they're taxing you. It feels like you're getting double taxed on it, but in theory, you're not necessarily getting double taxed. It's just that they took that money out to pay you back later, and then now they're taxing you on that benefit. So I know it feels like double taxation, but at the end of the day, it's truly just a return of the benefit that you put into the system. And again, majority of people, if they live a long time, get more money out of the system than they put in. So that's something to be very cognizant about. Now, here are some of the trade-offs, like I mentioned previously. Taking the Social Security benefit, should we take it later? Should we take it earlier? Depending on when you were born, if you decide to maximize that benefit, if you look at the top there, you can get almost 132% of that benefit if you just decided to delay it from 62. That means that we get an increase 8% every single year and we can maximize our benefits. Now, if you're born 1960 or later, that maximum FRA is 67. So that basically means that at 67 we get our maximum benefit. That could possibly change here in the future. Again, I don't know. They may deem us and make people like myself take it at 70. Who knows? But at the end of the day, at 67 you get the FRA. That's where you get your benefit, and you can delay it another 3 years to maximize that benefit as well and get a little increase on that benefit. Now, the beauty about it is there's a break even to all of this. And a lot of people don't realize that, because if you look at the bottom part there in the purple, if you claimed at 62, what would be your break even ages? So this is a perfect chart to show that. So if you claimed at 62, it says your break even age would be 77. 77 if you decided to take that benefit, or if you claimed at 77 if you claimed at 67. And then if you claimed it a little bit later, it'd be 81. So if you look at these different ages, it's basically telling you that, hey, if you're at 62, you claimed, and you decided to take it at FRA, your break even's here. But if you decided to take it at age 70, then your break even's here. So you see the different break evens at each point of life if you decided to take it. I think this is a beautiful depiction, because I get this question a lot, like, hey, Kevin, what's my break even on this? And generally it's roughly around 76, 77 years of age if you decided to take it earlier than FRA. People see that, well, I can get that benefit over a longer period of time. Yes, but if you live a lot longer, then of course you're going to get more money if you decide to delay it. The benefits of delaying is that if you have good health history, you get more money. The benefits of delaying is if you're married and you're a higher earner and you pass away, well, your spouse gets a higher benefit because you decided to wait. So it's those things that need to be taken in consideration when you're talking about maximizing on the earner with the higher income. Now, if you're a widow, there's possibilities where we can start taking it at age 60, or we can delay it a little bit later, and you can get that benefit based on your ex-spouse's benefit, on the deceased spouse's benefit, and that allows you to allow your benefit, your own personal benefit, to continue to grow. That no longer exists for people that are not survivors. If you're a survivor or a person that had a person that passed away, you can still use that file and suspend, quote unquote, but other people, they cannot. So that's a huge thing to look out there for. So here's some of the decision trees. And now what I'll do is, if you're on this call, I will shoot this out to you, because I think this is very interesting. A lot of you are already taking Social Security, but here's something that you can kind of consider if you're starting to take Social Security, or if you should take Social Security. For example, are you working? And if the answer is yes, you may want to delay claiming, because you'll get hit with the earnings test and all of the other things. But if you're not working, then we can go over to say, okay, what are some of the other income sources that you may have? So this allows us to kind of put a picture in front of you if you're looking to take Social Security at an earlier age, and if you're continuing to work. If you're going to continue to work, then maybe we shouldn't take it. But if you're not working right now, how can we maximize that benefit? Are we going to use your current assets that we have to maximize that benefit? I've always said this. I said the power in us to use our 401ks and other assets to maximize our benefits, it's there. There's no other plan out there that's going to allow you to get an increase in your income every single year as you delay it. Only thing that's going to do that for you is Social Security. I can't guarantee you 8% return in the market every single year, but I can guarantee you that 8% they're paying you in your Social Security right now, that's going to go up on your income. So if I can take that money out of the 401k and not turn on your Social Security benefit, That's going to allow us to maximize your Social Security over the long term, because now once we turn that Social Security benefit on, we no longer have to take that money out of the 401k. And by the way, that money is going to come out of the IRA, the 401k anyways, due to RMDs. So those are some of the tactics that we can use. And again, the Social Security decision tree is a phenomenal piece of information here that I think we all could use. Now, here's something. Let's just get down to the nuts and bolts of this, because Medicare, healthcare, taxes, this is all something that we deal with, especially when we turn age 65. There is a range where Medicare B premiums, you're going to have to pay these on a monthly basis. But here's the catch. Every time you go up on the income scale, your premiums go up. Your Medicare Part B premiums go up. This is what we call IRMAA, income-related annual adjustment amount. So what happens is this. You're getting the same level of service, but you're getting a higher Medicare B premium because you're making more money. So how can we offset this, Kevin? Why are we paying more for the same level of service? And I get it. And this is where we come in when we start talking about, we want to start filling up these IRMAA brackets as much as we possibly can, because what's going to happen to every one of you is this. We have this beautiful, huge IRA. But then when we get to 70 and a half, or 73, 74 years old, they're going to request RMDs from us. But what are those RMDs going to do? It's going to push us up the income brackets. And when those income brackets go up, our IRMAA tax goes up. And each and every one of you with large IRAs is going to pay a higher IRMAA tax based on that. So if you're concerned about that, that's when we start talking about, let's maximize our Roth conversions right now to minimize that moving forward. We can have further discussions on that as we if you would like. But that's some of the things we like to talk about in regards to minimizing the taxes we pay, even though this is not necessarily a tax, but it is a tax because you're paying a higher premium that you don't have to pay for. Medicare monthly surcharges. This is another one that I think is very powerful. It goes along the IRMAA. So the additional monthly premium per person on parts B and D in 2024, if you're in these tax brackets between 103 and 129, single, and 206 and 258 joint, was $83 a month. Oh, you say, well, it's $83 a month. Well, again, like I mentioned previously, once you guys start going up these brackets, it gets a little bit more expensive, especially when RMDs start to come into play. Look at 258 to 322 from a joint filing perspective. I have clients making that kind of money. Yes, it's 208 a month if you're single. And by the way, here's the catch. One of you, unfortunately, and I don't want to be that guy, one of you will end up being single in this lifetime. And what that means is your income on that RMD that's coming out, although the Social Security benefit is going to come off as well, but the income on the RMD amount is going to remain the same. So that RMD is still going to be coming to you guys, both accounts, jumping your income up. And then ultimately your income is going to be, and then you're going to be a single filer. And now that's going to basically push you up that IRMAA bracket, the monthly premium amount. So this is why we talk about Roth conversion so heavily, because we know that is an inevitability, and we don't want to put you guys in a disadvantageous tax situation moving forward. And I know we're talking about death. I get it, but it's also important not to give way too much when we don't have to. So when should you sign up for Medicare? We always like to say that, well, if you're working, you want to have creditable coverage for your from your employer. But you always want to typically engage Medicare normally a month or so before you turn 65. So if you're 65 and working, should you sign up for Medicare? And the answer is it depends. You always want to do Part A because Part A is free. But you also want to make sure that you follow this decision tree. Sign up for Medicare and stop monthly HSA contributions if that's a possibility. You still want to have access to an HSA, then you may not want to do it. But if you contribute to an HSA, if the answer is yes, or if the answer is no, that's going to determine your decision if you should sign up for both parts A and B. You typically want to sign up for part A because it's free, but part B and D and all the other things, all the alphabet soup, you may want to hold off on that if you have creditable coverage. So it's important to talk to your financial advisor about these particular things, because this all matters and what's going to happen to you moving forward, because you don't want to have missed opportunities and have a lapse in coverage, because there's penalties involved if you don't do this properly. So here's something I want to talk to you guys about from a Medicare perspective. There's 3 steps of Medicare coverage. One, again, you can sign up for parts A and B on medicare.gov. B, you can choose your plan. The original Medicare accepted by all Medicare providers, which is good. You get your Medigap and your Part D, vision, dental, and everything else is separate. And option 2, Medicare Advantage. Part C is limited to a network of providers, of course, but again, Part D and all the other stuff and vision that comes with it. So one thing I want you to understand is switching from Medicare Advantage to original Medicare. Medicare Advantage open enrollment is from January 1st to March 31st. You can leave Medicare Advantage and return to the original Medicare. You can also enroll in standalone Part D drug if needed. Medicare annual enrollment period. The actual Medicare annual enrollment period is October 15th through December 7th. You can switch from Medicare Advantage to original Medicare with coverage starting January 1st. There's a special enrollment period if you qualify due to certain circumstances, like moving out of your plan's service area. You may be able to switch between the plans if desired. For Medigap, if you leave Medicare Advantage and want Medigap, Medicare Supplement Plan, you may not be guaranteed coverage unless you are guaranteed issue situation. So switching from original Medicare to Medicare Advantage, there's an open enrollment period for Medicare enrollment from October 15th to December 7th. You can join a Medicare Advantage plan with coverage starting January 1st. Medicare Advantage and open enrollment January 1st to March 31st. If you're already in a Medicare Advantage plan, you can switch to a different Medicare Advantage plan or return to original Medicare. So you can kind of go back and forth with this. Most people I know just go to traditional Medicare. Now, what would make a person go to Medicare Advantage? Well, if they're single, if they're healthy, if they want lower premiums, that may be an option there. So if you're considering kind of going from one to the other, we can have a conversation and go over your plan needs for sure. Now, there's variations in Medicare costs. Like on the left-hand side here, you see the green that says Medicare Advantage premiums. Medicare Advantage premiums at age 65 are relatively low, but the out-of-pocket cost could vary. The out-of-pocket cost can be between $303 as a low and $427 as a high. Now, as you can see here on the right-hand side, those prices are expected to go up. You guys see the prices going up on all healthcare. It's not going to change. It's not going to change anytime soon. You have the PBMs and all the other people that are playing the game here. It's not going to change anytime soon. So if Medicare Advantage is the way to go, have that conversation. But again, you can also go back to Medicare. But again, some things may not be available for you. So just be aware. There's out-of-pocket costs for Medicare Advantage plans, and there's caps associated with that as well. So the last thing here from a healthcare perspective, because I know you guys get tired of me talking about healthcare, but there's rising healthcare costs in retirement. Medicare doesn't cover everything. Many retirees need Medigap or Medicare Advantage plans. Long-term care planning is crucial. Medicare doesn't cover nursing home care. On average, a 65-year-old couple will spend over $300,000 on healthcare in retirement. Planning for these costs early can prevent financial strain later. You see it on the right-hand side here. It says a cost inflation of 6% is expected for healthcare. So this graphic here is showing you that a monthly original cost of Medicare in 2024 dollars per person, $542 a month. Now with a 6% inflation rate, and in 20 years, 30 years, that's $1,400 a month. So this is the expectation moving forward on what the plans are looking like moving forward. And it's going to get nothing but worse, because this is the fastest growing cost in regards to inflation. So we talked about healthcare. Let's talk about some of the beauty about withdrawal strategies, maximizing our tax efficient strategies. We have to determine again what accounts are the best ones to have. Is it the Roth IRA? Is it the IRA, the 401ks? We all have these for retirement purposes, but we got to figure, well, how are we going to distribute these assets? So we have to prioritize withdrawal orders. Maybe we'll do taxable accounts first, not the non-qualified ones that have the 15% capital gains and the principal reductions. Then maybe we'll do some qualified accounts where we're talking about IRAs, so we can reduce the future RMDs. Then that can be followed by tax-free accounts like the Roth. So it's all important how we calculate this, because we want to calculate and minimize required minimum distributions. Like I said before, required minimum distributions will push you up in retirement from an income perspective. That is straight marginal tax rate dollars. So we have to manage those marginal tax rates because we want to minimize the cost from a retirement perspective on a tax for you. So that allows us to use tax efficient strategies where we're doing Roth conversions, maybe qualified charitable distributions from your IRAs. And again, if you're wanting to do charitable contributions and you're over 70 and a half, those distributions need to be coming from your IRA. That's the most tax efficient way to get those dollars out. It reduces your RMD, and it also is a tax-free distribution, but it has to be paid directly to the charity. So here are some of the tax implications for retirement accounts. I know we've been through this before. For pre-tax contributions like IRAs and 401ks, the contributions are pre-tax, the investment growth is pre-tax, and the withdrawals are all ordinary income tax. Now, from a Roth 401k, Roth IRA, contributions are post-tax, the investment growth is pre-tax, but for qualified withdrawals, it is all tax-free dollars. Now, if we talk about non-deductible contributions, post-tax, investment growth, pre-tax, and again, investment returns and gains are all post-tax. That's all ordinary income. But here is the secret weapon that no one likes to talk about: the health savings account. I love the health savings account because it's triple tax, baby. You got the contributions going in pre-tax. You got the investment growth going up pre-tax. And you got the withdrawals coming out pre-tax or post-tax, which basically means that it's all tax-free for qualified expenses. And like I just showed you before, the HSA can pay Medicare. You're going to have a lot of healthcare costs. So if you have the accessibility of a HSA or something that you can put money into for health expenses, I would say do it, and do it a lot, because there's going to be a lot of healthcare costs that you're going to have to pay for. And why not do that when you can get a tax deduction today and get a tax-free withdrawal tomorrow? There's no other account that gives you this, the most underrated investment account out there. Health savings account. So a couple more minutes here. We got diversified sources of retirement income that we just talked about this a little bit. Again, income taxes, health savings account, tax-free on withdrawals, Roth 401k, tax-free on withdrawals. The taxable account, you have tax-exempt interest, ordinary dividends. Now, ordinary dividends are different than qualified dividends. Ordinary dividends are taxed at the ordinary income tax level. Qualified dividends are taxed at a rate of 15 or 20%. That's the difference there. Realized capital gains, depending if they're short or long-term, 15 to 20% or ordinary income tax rates. Pre-tax 401k, traditional IRA, taxable withdrawals. So there's the beauty about this is that there's these accounts count towards, or the downside, these accounts count towards your Social Security percentage that's being taxed. If you see on the right-hand side over there, the boxes that are checked, the Roth, the pre-tax 401k and taxable account all count towards your amount of tax owed for your Social Security. But look what doesn't. Your Roth and your health savings account, they don't count towards that. So if you have two huge Roth and 401ks and you're getting maximum Social Security and you're taking all this money out of the 401k, the Roth, they're like, hey, the government only sees that you're making what $30,000-$40,000 a year, and you're being taxed at what 30 very low percentage on your Social Security. You're winning. You're winning. That's why there's a benefit on having those accounts moving forward. So RMDs, again, RMDs are powerful. Determine the accounts that have the RMDs, the IRAs, the SEPs. Identify the age. Again, 72 from Secure Act, it was like 73. I think they changed it to 75 even for some individuals. We have to calculate the balance at the end of the year. And then what we'll have to do is we'll have to apply the RMD percentage that will give us the amount that comes out of the account. Now, what I've said about this is a serious topic because a lot of people don't understand how this impacts them moving forward because all of their assets are in a pre-tax vehicle. We need to minimize that as quickly as possible and as much as possible. But with the current administration, it may not be that big of a deal. But again, there's going to be new administrations or further administrations moving forward that may see it as a big deal, and taxes may change. So we want to make sure that we minimize the RMDs moving forward because we don't want you guys to pay substantially amount of higher taxes. Finally, we're talking about life expectancies. This is a beautiful chart because when we talk about life expectancies, what do we know? Women live longer than us, man. That's just the case. On the left-hand side here, you have the women, the total population of women, and then you have the non-smokers and in excellent health. 52% of them are going to get to the age of 85. 72% if they're healthy. And if you go along the lines there, and this is a single woman, by the way, by herself, if you look at the man, it's a 63% likelihood that we're going to get to that 85% age. But it's a 39% if we're not necessarily as healthy, right? So what we want to understand is that there is a massive difference between if you're single and if you're married. Because when you're married, at least one of you, there's a 90% chance. 90% chance in the total population, 90% chance, especially if you're in excellent health, that one of you is going to get to 85. And a 73% chance that one of you, if you're in good health, is going to get to age 90. 46% chance of 95. What does that tell you? Hey, we got to live together. We got to live together because it's going to make us live longer for sure. But if you go down to the right, the far right, both of the members reaching the age, 46% chance if you're in good health, and 23% chance of age 90. So I'm telling you this to say that the risk of living until your age is 90 years old is powerful. It's not a risk, but it's absolutely a reward. But the reward is you have to have more money to be able to sustain the life that we're living. I don't want that. I'm sorry. So what we have to do is manage our retirement savings checkpoints. So at age 60, a household earning $100,000 a year should aim to at least have 8 times their salary saved. If you're behind, options include working longer, reducing expenses, or increasing savings. How much you should have saved? By age 50, 6 times your salary. By age 60, 8 times your salary. And by retirement, you want to have a minimum of 10x your salary for savings. If you're behind, again, options include saving more, delaying retirement, or adjusting your spending. This is a powerful, powerful chart. So lastly, we're going to talk about Roth accounts here. It's important because, like I mentioned to you previously, depending on where you are on the income scale, depending where you are at the age, it's important to say, you know what, if you're 20 years old, 25 years old, and there's not many of those on the call today, you want to do more Roth because you're going to end up making more money. But as time goes on and you make more money, you're going to start doing either Roth or traditional or just one or the other. Because as your income goes up, your marginal tax rate goes up, and do you want to put more money pre-tax into that vehicle? This is what this is telling you. When you're making lower income, you do more Roth. If you're making higher income, you do more traditional. That's the way of the game, because this is called tax planning. This is what tax planning is, tax planning 101. And as you get older, as you can see in the gray boxes, the RMDs start to come out. And if you start this way, doing more Roth in the beginning and traditional later, your RMDs are going to be much, much lower, and your taxes in retirement are going to be much, much lower. So I said the triple tax exempt monster before, and I meant the triple tax exempt monster because HSAs are a powerful tool to pay for medical expenses tax-free. Contributions are pre-tax, they grow tax-free, and withdrawals for medical costs are tax-free. If you're still working, maximizing your HSA contributions is a smart strategy for retirement healthcare expenses. Now, why do I say that? Why do I say that? Here's how it works. Let's just say I put money into my HSA every single year and I maximize that and I put it into an investment account. Let's just say I never use my HSA to pay for medical expenses. I just pay that out of pocket, right? But I keep meticulous receipts of that over the next 10, 15 years. There's apps for that. I use the Lively app. There's apps for that. You can just keep your receipts on your app. So guess what? Those costs grow and grow and grow and grow and grow. And guess what? All that money you put in over the last 10, 15, 20 years, cough syrup at CVS, dental appointments, eyewear, all that cost that you paid out of pocket can now come back to you in the form of HSA distributions. Tax-free, my friend. You've already paid it. That's the benefit of this account. And by the way, when you start having Medicare costs inside of retirement or Medicare premiums and all that stuff, that comes out of your HSA. Beautiful, beautiful tool. Sorry. So last thing we're going to talk about here is long-term care planning. Again, this is imperative because we have long-term care issues. The duration of a paid care for 65 years old and older, if paid care is used under 3 years, the duration is 33% of the time. For women, 38% of the time for men. 3 to 5 years, 26% for women, 26% is basically even. In 5+ years, 41%, 38%, 36%. And the reason why it's for 5+ years, the duration is longer for women is because women live longer. Men are typically passed away by that time. The average duration for long-term care stay in a facility is less than 3 years. People jokingly say they go in the front door, they come out the back. I'm not trying to be funny, but that's what they say. So the lifetime cost of care for 65-year-old, if paid care is used, the average cost, $278,000 for women, $200,000 for men. And again, the reason why it's less for men is because men usually don't last as long. This is why having HSAs, this is why having insurance, this is why having other things attached to this is important. Now, getting standalone insurance is tough. It's very, very expensive, but it's important to have other assets. And that's why people have huge 401ks or huge IRAs to pay for these things. But guess what? You're just getting banged on taking that money out because it's all at income tax rate, marginal income tax rates. Maybe we need to have a conversation about if there's a possibility of people taking distributions. Well, you can via QLAC, and we can have that conversation. You can take money out of your IRA, put it into a qualified longevity annuity contract, and that money can come out. It's not a taxable event, and that money can be used later in life, 15, 20 years in life, to pay for these long-term care issues if that's so desired. That's one way people have been using qualified longevity annuities to offset their long-term care expenses, is by taking money out of the 401 out of the IRA. That money now comes off the RMD, so that's less money you owe in RMDs, and that money is going to come to you in the future to pay for your long-term care expenses. So here's some long-term care planning options. You can use family and friends, savings and expense reductions. Again, some expenses such as travel may go down, but there again needs to be some planning around this, because insurance options are being limited. They're going up. The costs are going up for insurance options. So we don't have the availability for that. As you get older, there's less and less availability for insurance, and the cost is going to continue to rise. Life plan communities often start with independent living and offers additional services and facilities when needed. And people can tap into their home equity. there's one option there, tapping into home equity that can help pay for these things as well. So those are some of the options there. Of course, like I mentioned before, health savings account, maybe use it tax-free for qualified expenses in retirement. Those are some of the options from a planning perspective. So lastly, long-term care planning. It's important for us to assess our current financial position. We got to gather these information in details because, again, we don't want to get you in a situation where you're using up all of your money. We got to determine the long-term care needs, what the family history looks like. We got to explore long-term care options, what kind of accounts we're going to use. Research long-term care options such as in-home healthcare, assisted living, nursing homes. Develop a financial plan around these particular events. I've always had conversations with clients saying that, what does that look like? Has dementia or Alzheimer's been in your family? What does cancer look like? What does these issues look like? It's important to have these conversations. And we got to review and update this every single year. It's not just about the portfolio, it's about you. So the last thing I said, I know it's been volatile lately. Again, there's an impact of being out of the markets. I want everybody to understand that I know it's been a volatile time. Don't let people push you out of markets. It's important to stay invested because what do we know? The United States market has been up and to the right for a long period of time. And missing just 10 of the best days can cost you tremendously, or 20 of the best days, or 30 of the best days, or what have you. We stay fully invested. Now, I know that's easier said than done, but I get it. If you have concerns about what's going on right now, raising a little bit of cash, there's nothing wrong with that because we're still getting 4.5% in money markets. And we're not missing out on anything. But just going all the cash and getting rid of everything, that's not the option. So let's just make smart decisions. I hope this has been a valuable use of your time, guys. Again, we talked today about healthcare, taxes, IRMAA, Social Security, long-term care, how it impacts you. This is what we do here. We are a premier financial planning firm. We want to make sure that you have a firm understanding of what we do, how we do it, and what some of the information is. I don't like to keep these long, so I know I just went 35 minutes. And what I'm going to do, again, here's my email. There's our social. We're on MLB to CFP on all social channels. And again, our LinkedIn is Kevin Thompson. You can find me there. But if you have any questions, you can email me at kevinthompson@9icapitalgroup.com. I hope this has been a valuable use of your time, guys. Please, I will have this on the YouTube station here at the end of today, and I will shoot it out to everyone. So thank you guys for joining me. Stay humble, stay safe. We'll see you guys again soon.